Hi everyone, today also let's discuss another past paper question from the area NPV. Today we are going to discuss 2016 paper 2 question number 5 part A. For a 400 mark paper, this particular question will count for like 10 marks. So let's go through the requirement first, what they are asking. A schedule comprising cash outflows and inflows of this project. And second one, they are asking us to calculate the NPV. Third one is the recommendation. So it's a normal question how they have tested for other past papers also. Now let's go through the scenario. A manufacturing company is considering to replace the existing machine with a new machine to improve the efficiency of its operation. So understand, there is a company, that company is currently using a machine to do some production. Now what they are planning to do, they are planning to replace that old asset with a new asset. So what you have to understand, if they replace the old asset with a new asset, because the new asset's efficiency is good, obviously there will be some saving in the cost. But let's read the scenario and see whether there are any saving in the cost or not. The useful life of the new machine is 5 years. The following estimated cash flows related to two machines are given below. So they have given the cost of the new machine. So what you have to understand, this is going to be a cash outflow for the year 0. Then current market value of the existing machine. So what you have to understand, if we are buying the new machine, no point of keeping the old machine, we have to sell it. So if we sell it, we will get that money. How much money we will get? 300,000. So it's going to be a cash inflow for the year 0. So you see, whatever the cash outflows, I am writing the year inside the brackets. Inflows I am just keeping as it is without any brackets. And next one, they have given residual value of the new machine. So after I use the machine for 5 years, I can sell the new machine for 200,000. So this is going to be a cash inflow for the year number 5. And they have given the annual operating cost. This is a good thing. Now here you can see, if you are using the old machine, your cost will be 300,000. If you are using the new machine, your cost will be 100,000. Then understand, because of the new machine, because of the investment that you are making, what is the saving that you are getting? This is what I told. If you are moving from old machine to a new machine, obviously there will be some savings because new machine's efficiency will be better. So here see, if we are using the old asset, we will have to incur a cost of 300,000. But if we are using the new machine, we will have to incur a cost of only 100,000. So there will be a saving in operating cost. Saving in operating cost. So first year saving is how much? 200,000. Second year saving is how much? 200,000. And third year, how much is the saving? If you use the old asset 320, new asset 120. So the difference is how much? 200,000. Saving will be 200,000. Here 320 cost will get reduced to 120. Again there will be a saving of 200,000. Here 360 cost will get reduced to 140. So there will be a saving of 220,000. If the machine is purchased, an additional working capital of 280,000 will be required at the beginning of the project and it will be recovered at the end of the project. So what you have to understand with regarding this 280,000, there will be two adjustments. One is in year 0, you have to send that particular money into the project. So your money is going out in year 0. After 5 years are over, you can recover that money back. So it's going to be an inflow in year number 5. And they have given the required rate, which is the 10%. So let's prepare the cash outflow and the inflow schedule. So let me do it over here. Question number 5. Question number 5. Part A of that first one. So let me take the cash inflows and I'll leave few lines, and here let me take maybe the cash outflows, cash outflows. So I'll take the years here. Let me take the year 0 and year 1, year 2, year 3, year 4 and year 5. I'll do the calculation in rupees 1000. Now let's go through one by one again. So this one, purchase cost year 0 outflow 1000. Purchase cost of new asset, of the new asset 1000, year 0 outflow 1000. So we are done with that. Next one, sales of the old asset. So it's an inflow. Sale of old machine. What's the value? 300,000. 300,000, it's inflow. So we are done with that one as well. And next one, residual value of the new asset. 5th year after using the asset, new asset you can sell for 200,000. So residual value of new asset, residual value of the new asset after 5 years we can sell it for how much? 200,000. So it's going to be an inflow. And next one, saving in operating cost. So normally savings will be considering it as cash inflows. Saving in operating cost. So first year, second year, third year, fourth year, 200,000 each year. 200,000, 200,000, 200,000, 200,000. Last year how much is that? 220,000. So we are done with those savings as well. Now you have the working capital. Working capital year 0. Working capital year 0. So working capital injection. How much is that? 280,000 in year 0. And you can recover the working capital. So working capital recovery. My handwriting is little weird, but you have to write it nicely. How much is that? 280,000. So we can recover it back. 280,000. So now let's get the total inflows and outflows. Here 300, here 200, here 200, here 200, here 200. Here it is how much? 300, 500, 700. Here let's take the cash outflows also. So here 1280, nothing. Then now let's get the net cash flows. So here how much? 1280 negative, 300 positive. So here 980 negative. Here 200, here 200, here 200, here 200 and here 700. So here in the question number 2, what they are asking us to calculate the NPV. So schedule of cash inflows and outflows, that is done. So now we are doing the question number 2. So let's multiply this from the discounting factor. Discounting factor is 10%. Discounting factor is 10%. Here it is 1. Here it is 0.91, 0.83, 0.75, 0.68, 0.62. So let me confirm the discounting factors. 918375, 918375, 6862. Now let's get the present values. Present value. So here it is 980 negative. 200 into 200 into 0.91. So let me take my calculator. 200 into 0.91, I am getting a value of 182. Then next one, 200 into 0.83, I am getting a value of 166. Next one, 200 into 0.75 into 0.75, 150. 150. Here 200 into 0.68, 136. Here 700 into 0.62, it is 434. Now let's calculate the NPV. Let's calculate the NPV. I'll get it to the next slide. NPV is how much? Minus 980 plus 182. So I'll take the plus values first. 182, 166, 150, 136, 434 minus 980. So I am getting a value of plus 88. That means plus 88 means NPV is rupees plus rupees 88,000. Then part C of the question, what they are asking. So we are done with this. Part C of the question, they are asking the recommendation. So you know, if the NPV is positive, you have to accept it. If the NPV is negative, you have to reject it. So here let's write the recommendation. Third one, since the NPV is positive, it is recommended to proceed with the investment. It is recommended to proceed with the investment. So this is how you can do a NPV question. That's simple. So simply here, if you look at this particular question, the extra difficult part is only this identifying the saving in the operating cost. So this is not only the past paper NPV question that I have done. On the screen you can see the playlist for other NPV past paper questions also. You can click that playlist and you can watch the other past paper NPV questions that I have discussed.